you. We'll get started and we'll get this thing kicked off because this is sort of an exciting topic, but more importantly, any topic can be exciting and interesting based on the level of expertise and the level of insight you're going to get from the people who are talking about it. And so while we have a great topic to discuss today, I'm even more excited about the experts who are here to discuss it. And it goes without saying, huge thank you to our partners and our friends at Winston and Strawn. You know, Juan and I go back a long way, and it's hard to pinpoint sort of his area of expertise because whenever I'm in a jam, he's the first person I call. I can confirm here for everybody listening that I will not be running for mayor of New York City. I have no intentions of running for office ever again. But again, appreciate all the warm wishes and the encouragement. That being said, as you all know, this is the Future of Finance webinar series. We're joined by a panel of experts who are all either members or strategic partners of the American FinTech Council, a standards-based trade association that encompasses all areas of fintech innovators, including innovative banks offering embedded finance. You have our best representation as panelists here today, and I'll kick it over to you, Juan, to take us into the conversation and get the conversation going. But on behalf of the American FinTech Council, I just want to say thank you to our panelists and obviously everybody who's here joining for taking the time out of your day. And I'm sure you're going to get the benefit you came to hear from this amazing group. So with that one, I'll kick it off to you.
No, thank you, Phil. I appreciate it. I think you're going to enjoy the panel. Perhaps not enjoy the the notice of proposed rulemaking. I think it's caused a lot of consternation across the industry and across many of our clients. I'm Juan Azel. I'm a partner at Winston and Strawn. As Phil mentioned, we go way back. We go way back with a lot of people on this panel. But Phil and I were previously colleagues at Cross River some time ago. I'm joined really by a great panel of experts here, and I'm just going to ask them to introduce themselves briefly in case you don't know who they are. Just based on the boxes on my screen, no other priority. Jason?
Jason Chorlins here with Kaufman Rossin, strategic partner with the AFC. I've been with Kaufman a little over 17 and a half years. I lead our financial services practice and happy to be on this panel.
Adwait?
Adwait Joshi, founder and CEO at DataSeers. We are a data-focused company working with a lot of financial services firms, banks, credit unions, other fintechs. For the past 15, 18 years or so, I've been focused on helping folks understand data, reconcile data, amongst other things. Glad to be here.
And Chris?
No, Juan and Phil, thank you for the opportunity. Chris Black, CEO of Thread Bank, which is a embedded banking focused in embedding deposits, loans, payments into our partners, which really are Main Street banking, Main Street economy. So glad to be here.
All right, thank you, panelists. I'm going to just go through a brief summary of the rule. I think it would help set the discussion. Just a few minutes, and after that, then we're going to go with some questions to the panelists. If during and I'm sure you're going to have some questions, if during the presentation and the discussion you have questions, just put them in the chat, and then we will set some time at the end to discuss, and try to answer some of the questions that you may have. So let me share my screen here for a moment because we put a bit of couple of slides here that I think will be helpful in really understanding what it is that we're speaking about here today. I started the slide with a question, and you'll see that we're going to ask the panelists this question. Are we stepping backwards, right? We know that on July 30th, the FDIC issued this notice of proposed rulemaking. But if you take a little step back, and those of us that remember, even prior to the 2020 rule, I think it's probably not an exaggeration to say that everything was brokered when it wasn't a customer coming to the bank and opening a deposit themselves. Really, any BaaS relationship was very difficult to truly categorize as not brokered. That's why we were also happy, right, about the 2020 rule and all the work that was done in there. And And since the internet lives forever, I found an interesting quote from the FDIC back in 2020 when it issued the NPRM, and it said that it was seeking to modernize the regulations related to broker deposit, which, as we know, were put in place back in 1989 in order to reflect technological changes and innovations across the banking industry. I think I speak for many of us. This is, great words, right? This is what we want to see our regulators do, given that not just this regulation, but many of these regulations, particularly in the consumer protection area, were passed at times where financial technology was Star Trek, right, or the future. So the modernization is very necessary for this and other areas. So what's happening now? What has happened? All of a sudden, it was a surprise to me, and I don't know if it was a surprise to everyone. All of a sudden, you get this rule, that seeks to essentially undo or reverse the 2020 rule. And in issuing the notice of proposed rulemaking, the FDIC states that these changes are based on its experience since the adoption of the 2020 final rule, which is really only 4 years, right? No more than 4 years ago, and then the bank failures in 2023, and then states that the proposed revisions seek to strengthen the safety and soundness of the banking system and help ensure uniform and consistent reporting of brokers' deposits and reduce operational challenges and reduce reporting burdens and insurance depository institutions. I am sure that is not without debate. But I think the key point here, as I'll move to the next slide, is, when we think about whether this makes sense, right, is that the FDIC points to the failures of non-bank deposit broker we know, Synapse, and everybody's aware of that, as well as a crypto company, Voyager, as rationale for the sweeping rule changes, which I think, and I'll ask the panelists what they think about this. I think it's kind of odd that such a sweeping reversal of a rule would be based on the failure of a middleware company and a crypto company. And then you see that the FDIC claims that these changes would help reduce the very serious risks that broker deposits pose to less than well-capitalized insured depository institutions and the fund, right? But as we see in the rule, okay, that's all great. So we've got Synapse, we've got Voyager, then we've got less than well-capitalized institutions, but then we have a change that applies to all financial institutions, even the most well-capitalized. Does that make sense? Right? I think, and this is for perhaps a little bit of editorialness here, an opinion, but it's my opinion. I think the intent is clear, right? Sorry for the typo there, but it's increasing the proportion of deposits that are treated as brokered. I think that's the intent, and force banks to reassess, their arrangements currently in place relating to deposits, right? Mm-hmm. We will talk a little bit about a related rule, maybe perhaps a sister rule on custody accounts, and whether that has anything to do with this, but is really the intent here to reassess BAS arrangements, right? And I'll throw it out there just to think about as we move forward in the discussion. So let's very briefly, because I really want to get to the panel, and this webinar is not intended, I'm sure you've all read it, and there's a lot of commentary out there. It's not intended to go over the whole NPRM, but just so we can set up the discussion. Some of the changes are as follows. The definition of deposit broker has now been revised. Right. The matchmaking activities definition has been removed, and it's been replaced with a broader definition relating to deposit allocation services. And I think very critical, a new factor related to fees. So, for example, if you think about BAS arrangements, even with an exclusive, and we'll talk about that in a second, where there's referral fees being paid, right? There's a monetary exchange going hand in hand. It's going to be a factor, and I don't know why anybody would do that without some type of revenue. So it's going to be something that's going to be very interesting. How much weight is going to be given to that, as to whether that person is engaged in the placement of deposits. I think something else that's going to affect a lot of really non-bank institutions, even, and I wouldn't say non-bank financial institutions, just non-bank institutions as well, like regular companies that have, are offering services to a particular customers in the range of, let's say, high yield deposit accounts and things like that, is the elimination of the exclusive deposit arrangement exception, right? This was very critical to a lot of these non-bank institutions who were able to, as long as I place deposits with just, one particular bank, I can rely and not be considered a deposit broker. And that's gone. And again, gone for everybody, less than well capitalized, and everything. And again, it's a head scratcher to me. But that's the way the rule is reading at this time. The other big, I think, change is revising the interpretation of the primary purpose exception to consider the third party's intent in placing customer funds at a particular IDI. Along with this is essentially the undoing, which I think is just another huge issue of all these banks and other non-bank entities that went out and obtained these primary purpose exceptions. Now they got to do it all over again. All of that stuff is thrown out, and now you got to go and reapply. And now only the bank can reapply, as you can see here, not the third parties. And now the intent of the third party in placing customer funds. This is where the fees go into effect as well. Are you making some money out of it? And again, I'm not sure why you would do it without it, but that's what it is. All of that goes away, and now you have to redo it all over again, and only the bank can do it. So no more of the fintechs can do it. And then I think another big change is this, designated business exception, right? So if you don't want to do the PPE, you've got certain kind of like safe harbors. One was a 25% test, and now available only to broker dealers and investment advisors and RIAs. I don't know if this particular group lobbied the FDIC for this. It's interesting that this was kind of like, great, not only you get to use the exception, broker dealers and RIAs, this 25% test. So it really has gutted this exception as well. I think the intent here is that if the FDIC felt perhaps that people were relying on this exception a little bit too much, and since it's designated business exception, then it didn't have to, in many cases, just provide notice that you were doing it. And then I think just the other two lesser exceptions, not lesser in the sense of in importance, but the enabling transactions designated business exception was eliminated primarily because they felt that the definition of deposit placement really swallowed that exception, as I understand it. And then, just to clarifying that when an IDI loses its agent's institution status, it can regain it. But that's not more of the other exceptions are obviously more or more changes are obviously more important, right? So just some wild cards here, right? Before we jump to the panel, we got to keep in mind that this is an NPRM, right? And the fact is that NPRMs that contain sweeping changes like this rarely go into effect exactly as you're reading them. Doesn't mean it can't happen, but I think in most of our experience it's rare. And this one has a lot of strong opposition already, including by the AFC. You may have seen the letter that was sent by the AFC along with the ABA and other industry groups, essentially, requesting removal or revocation of the NPRM, and if not, at least some extra time to respond to this. And then we can't forget the Loper decision, right? Every agency action these days is going to be reviewed. We think under this analysis, when it applies, the Chevron deference is gone. So in terms of the interpretation of a statute, federal agencies have lost a little bit of deference in that area, a lot, depending on how you look at it. And I think this could increase the likelihood that the NPRM will be challenged in the courts. Remember that, as we know, part of the problem here is that when deposits are not considered core, they cost more in deposit insurance. So there is a taking here, right? Maybe perhaps it's costing more money. So think of maybe a trial lawyer, an interesting constitutional argument along those lines may come about. So just final things. Remember that the comment is still open. Comment period is still open. So there's still time to submit or join a group submitting comments. That's due by October 22nd, 2024. And this is another opinion of mine. I do think it matters. I do think they make a difference. There is still time to change some of this. And just also, if this is not withdrawn or reversed by the court, or even, doesn't make it exactly how it is, the fact is that banks will have ample time, right, to reassess the arrangements and comply with those regulations. That may be just a little comforting thought, but it's not something that will be all of a sudden, January 1st, you're going to have to comply with all of this, right? All right, so let me stop sharing my screen here, and I'm going to go to the panel right now as soon as I get situated here with the first question. All right, so the first question I have to the panel, and anybody feel free to jump in on this, is let's talk about why this is happening. So why do you believe, or perhaps has even triggered the FDIC to issue this NPRM just a few short years after issuing a final rule in the same area? Anybody want to jump in?
Yeah, Juan, happy to jump in. I'll give you an analogy, right? It's like there is a street, you're able to drive at 55 miles an hour, a bunch of accidents happen. Now suddenly the city's coming in and reducing the speed to 45, right? Like you showed earlier, bank failures, the whole Synapse issue that happened, right, has made them rethink about who's in control here. And at the end of the day, is the end customer going to get affected as a result of it, right? And this whole scenario of Synapse is very interesting for me. Yes, it's a failure of a middleware bank, right? Middleware provider, I mean. But think about it this way, that the problem there was nobody was able to reconcile the end user funds. The database went away, people did not have access, and everybody relied on that model, which they technically do rely on even on the core banking side, right? If you have a core banking provider like a Fiserv and FIS, you depend upon them to provide the balances for you, right? You don't worry about them going away. Right. So, what is really the difference between the deposits that come from the fintech and deposits come from a direct customer, right? In their mind, the lack of transparency, the lack of proper business model, the lack of proper contracts of having the full connection, I think has caused them to send it out as okay, we are wanting your comments on it. That's just my take. I'm not a banker, so I have a very different technology, perspective on it, but that's at least my perspective on that.
Yeah, I'll chime in before Chris gets in there. Agree with what Adwait says. Obviously, you mentioned Synapse and Voyager and the concerns around what happens when you have a lack of a reconciliation or controls in place to address certain balances. But I think obviously over the last 4 years since the 2020 rule was out there around broker deposits, we've seen a really rapid growth of fintech companies, online banks, peer-to-peer lenders, neobanks. That's really changed how we source and deposits. And I think a lot of those platforms that rely on digital models are attracting customers from everywhere, which tends, in this case, to blur some of those traditional definitions of broker deposits. So, having these new intermediaries, I know you mentioned the Synapse and middleware providers that are really sourcing a lot of these deposits, has, I think, led to some of the concerns that are trying to be addressed by the broker deposit rule, but may have unintended consequences, like you mentioned, Juan. And I think, one of the key areas that you mentioned is the growth in high yield accounts, right? With the rise of these high yield savings accounts, it's really banks have aggressively pursued, deposit growth through the use of partnerships, or you mentioned non-bank companies or intermediaries. And I think that creates some of the concerns around potential concentration risk, financial stability, or deposit flight, when rates, people are competing in high rate environments.
Yeah, Juan, I think, certainly agree with what Jason and Adwait have said, but I think this is cutting to the heart, and this situation is cutting to the heart of a really fundamental problem, which is really serious for all of us. And when I say all, it's financial institutions, service providers, regulators, customers, most importantly. And this is, I think it's a really unfortunate way for the agencies to express kind of their concern, which they should be concerned, right? Anytime you've got customers being harmed and banks failing, there's something happening. But the title of Phil, the title of this problem in search of a solution is kind of what this is exacerbating. And if we could, put pause and take a period of time to really educate that whole ecosystem on what's actually happening. And when we think about our bank, I mean, it's a really actually very simple business model with some important distinctions and important complexities that can kind of cause confusion. But we are a bank. We have a couple of physical branches, and then we have a number of virtual branches, which is how we think of our partners. Through those partners who have existing and oftentimes very deep relationships with customers, small businesses, they're a vertically integrated SaaS solution that as we bring in banking products and services directly into those branches, we only deepen the relationship with those customers. We only strengthen and really actually create more core deposit relationships than many banks have in 2024 in their existing brick and mortar branches. And I just think it's such a fundamentally misunderstood and misapplied principle that is kind of answers all so many of these issues. With each of our customers, we have exclusive relationships with our partners, and the customers open accounts on Threadbank's end user deposit agreements with all of our disclosures. Our people, we totally run the risk management, the BSA, all of these things within our program. And the difference here is where does the employee or the technology or whoever it is that's interacting with that end deposit customer or lending customer, where do they get their W-2? Do they get it from the bank, or do they get it from another company? And that answer describes a different level of complexity and third-party risk management, which is serious, but that's what the program is built about. Nowhere in here have we even touched upon the notion of deposit, broker deposit, or some other thing, or a pink pony floating in the sky. Like, these are labels that really don't mean anything for us. Like, a broker deposit has never meant much to me other than it was some convenient label to try to put restrictions and some type of control around a concept which really doesn't apply. We use we have a very large deposit sweep program, and we use brokered deposits, the real brokered deposits, CDs, for interest rate risk management and for other. And so these are very valuable tools when used in the right manner. And our deposits that come from our partners are core in every sense of the word. So we have really strong relationships, as I mentioned, strong technology. We provide substantial automatic FDIC deposit insurance automatically through those. And then even further evidence, the rates that many depositors are achieving in those accounts are nowhere near where broker deposit rates are. So that's even further evidence that these are not broker deposits at all. So I think what is the MO here and what's going on is just a nervousness over a bad course of events that has occurred, and trying to do anything that the agencies can to get their arms around it, which we're sympathetic to. And we want them to get their arms around it. We want to do these things together in partnership and full understanding. So we ought to all be taking a pause, taking a step back, and what can we do to educate based upon the facts and the fundamentals. And then if there are things that need to be adjusted from there, we're on board. We're all for it. Let's go do that. But it's just kind of a left field solution that is not even connected to the issue at hand. Sorry for a long answer, but it's all
No. I think there's a lot of great stuff in there, and I think many people share that sentiment that it seems to that this could have been done with more finesse, right? Because to your point about knowing who the customer is and it being really more core and less flighty. When you take this in connection with, as I alluded to earlier, the recent NPRM on record keeping for custodial accounts, right?
Mm-hmm.
It seems like and I'll ask a question to the panel there in a second, but it seems like when you look at these things together, you're talking about a concern about less than well-capitalized banks and a situation where there's a middleware company and perhaps the bank doesn't quite have because it's a custodial account, doesn't have the same type of designated individual account you mentioned, Chris, with the individual customer. And those things are leading to the possibility that those deposits could be more flighty and affect a less than well-capitalized bank. And you know, that's how I read it when I look at it. But then when you look at this NPRM, it's so broad, right? And it applies to to just it can apply to a very well-capitalized bank and a bank that's opened up individual designated accounts. And is that really what we're trying? What we're trying to do here. So in terms of that recent, record keeping, do you believe, and this will move us into the next section, does the panel believe that the FDIC is targeting banking as a service and sending a message to that industry? And if so, what's the message? Maybe Jason.
Go ahead, Chris.
I don't think they're I don't think they're targeting an inch like you're on a bad boy list and we're going to just stop this. I think they're targeting perceived risks that are really concerning to them, and they believe they manifest themselves because of the third party and and the complexity. So I think that's what they're doing. If we really looked at what's happening in the failures had nothing to do with end user deposit accounts, brokered or not. Synapse had to do all with poor record keeping, which by the way, I think for my part last week what the FDIC put out, we looked at and said that's eminently reasonable and a great standard, and we're happy we're ahead of what that standard suggests, and we think that's what banks should be doing. One, two, and you'll probably get to this, but First Republic and SVB failures had almost precisely, if they had anything to do with brokered deposits, it was that they didn't have brokered deposits. Had they brokered deposits, they might still be with us because they could have managed their duration risk and their interest rate risk, which they did not. It was their high concentration of uninsured deposits concentrated under the control of very few people who could move those deposits and make them run. So it's precisely the opposite of banking as a service, per se, how the way that we do it with primary deposit customers. And if we were to follow this proposed rule, we would of course have to follow its rules if it became the law of the land, but it would incentivize banks who are doing this to actually become much more like SVB. So it's pretty wild. You would move off the brokered deposits, which are granular, mostly totally insured. They would move out of the bank, and none of those deposits are under the control of a venture capital firm or anyone who caused the SVB crisis by pulling deposits. But if we went and took the corporate deposits of our partners or our customers by the tens of millions, those would come in the bank. They would be called core, and they would be absolutely concentrated and subject to flight. So it's kind of like bizarro world, up is down, down is up. So that's why we just need to all, I think, take a step back, which we're all trying to force a pause here, right? Like, let's talk about this and think about it.
Yeah, and to that point, right, I think more time to obviously look at the impact and what that would be. Is it truly targeting BAS, or is it more a reaction as to a couple of failures that have happened and trying to, in their mind, level the playing field when they're indirectly impacting more well-capitalized banks versus not well-capitalized banks? And I think where there's a lot more opportunity in this is kind of like what you mentioned, Chris, and Adwait before, is let's focus in on the controls that we have around these types of deposits. Let's focus in on ensuring that what happened with a middleware provider isn't going to happen at a more well-capitalized, risk-averse bank that has robust risk management frameworks already in place. And that includes, like Chris mentioned, interest rate risk management, right? And how we can, ensure going forward that, deposits aren't as a flight risk as we see before, and converting those into core deposits. And I agree with you, Chris. There's it's going to create a lot more confusion as to moving these deposits around. And why are they targeting these? Is they've seen expansive growth in financial institutions that are offering banking as a service, and seeing their assets that are coming over, right? The deposit liabilities that are being brought in from these, and trying to, in their mind, find a way to kind of create that level playing field and apply rules to both well-capitalized and non-well-capitalized banks.
Yeah, and to add to that, Chris, I think you mentioned concentration risk, right? That's one thing that's very important because there are banks in this space today who have severe concentration risks with certain fintechs, and that doesn't help because the fintech can decide that they're going to move overnight and change and start a different strategy. And we have seen that happen, right? In the past 1 year, we have seen banks getting out of the business and suddenly new banks onboarding those clients, right? I mean, the movement is common, it happens. And so when you have so much of concentration risk with any one partner, that doesn't make it easy. So I think it's up to each institution to ensure that they're not going to get affected. Some people may have a strategy, like Chris, you said, where you spread it out, right? You don't let anyone increase the concentration. But that's no different than having one customer who puts $1 billion in your bank and then moves it away.
No
right?
different. They could move it tomorrow, right?
Correct. They could move it tomorrow, and it happens all the time too. So it's kind of a double-edged sword there, right? I think to me, they're trying to throw a net out there, throw spaghetti at the wall to see what sticks and what kind of comments they get back from this.
I might say I agree with you, but I might say on the concentrate, and I think maybe the most important thing you said in all that is each institution's different, just like any, right? So one CRE loan portfolio over here, they may have the same on the surface, high level, same characteristics, but it's very different because how that institution manages the risk and what its mitigating factors are, what the rest of its business strategy looks like, can, what might be a concentration over here is not necessarily over here. And, like for us, all of our relationships are exclusive with our partners, but all of our deposit agreements are with our end users. And so you don't have a situation when it's like that against the bank's will, where someone could just pick those deposits up and move them in some rapid fashion. And you all have been a part of conversions and moving debit card issuance and routing numbers and and all these things. So that's more on kind of exit plans and contingency planning, again, to that risk management of the institution. So I think this is much ado about nothing in many ways, but everything to do with the fundamentally core questions of what we're talking about. But the solutions are eminently obvious and eminently right in front of us. And there are many. In fact, I think the vast majority in the industry who understand these things and are doing them the right way. So it's a matter of kind of getting through this storm and bringing the regulators along with us, bringing them in close, being very transparent, and helping them to see that, in fact, what we're doing, it's the same customers that we're banking. They just have chosen no longer to be in a physical branch. They're going into a virtual branch that works better for whatever their purpose is, whatever, as a citizen that they want to do.
That's that's a good segue. This discussion onto the impact of what we're seeing here, right? I mean, very recently you might have seen a public announcement by Five Star Bank, which full disclosure is a client of Winston Strawn, that announced its intent to begin winding down its BaaS offering. And the public announcement specifically listed about as a factor the evolving regulatory expectations and a proposed rule regarding the reclassification of BaaS deposits as brokered. Do you see, to the panel again, do you see the impact of this NPRM, which is already having an impact, as we see with Five Star and others, as really causing banks to, like Five Star, to perhaps consider its BaaS business lines? Or do you think those banks are more likely, given that this potentially affects or really likely affects the economics of bank programs, as holding those deposits will cost banks more in insurance premiums, as affecting essentially the economics of BaaS programs and negotiations? Or do you think this is something that will cause more and more banks to leave this business behind, this particular fintech product behind?
I'll quickly chime in there. I think, in this case, Five Star is not unique. There's other ones out there that have reevaluated their position in the marketplace as far as evolving regulatory frameworks and how it's going to impact them and their structure internally. Five Star is just one that's citing citing that as the obvious is that the changing regulatory framework has an impact on how they do business from banking as a service. But I've had other clients as well that have said, you know what, because of the regulatory burden we face, the additional scrutiny on our risk management programs, this is not within our risk appetite anymore. It's become too costly. It's going to cost us the opportunity to make additional revenues because, the idea for them was to bring in deposits at lower cost, right? And be able to make fees and revenue on the services that they were going to offer, but it's certainly being outweighed by the cost of compliance. And I think a lot of that has impacted a lot of financial institutions, and looking at it from a cost benefit analysis is, how long can we actually be able to service our clients if we can't scale? Does it make sense to only have a small handful of programs on our balance sheet? And I think if that's the case, some are just saying, it's easier to walk away from it now than face, either more significant consequences, whether it's reputational risk, the risk of remediation, the ongoing scrutiny of having a BAS program and being treated as a novel bank. I think that is kind of driving. Now, this notice of proposed rulemaking obviously is adding to fuel to that fire, right? It's okay, now we, what's the additional cost of carrying these deposits? What additional risk considerations do we have to have as a financial institution to ensure that we can manage these deposits along with what banking as a service brings, which is the additional scrutiny and risk management frameworks?
Yeah, I think Juan, I'm such a big believer in the free market capitalism. So long as our Constitution remains in force and kind of the will of the people is done, it's an unstoppable force. No matter the U.S. government can't stop it, the agencies can't stop it, no bank can stop it. It's water and capital flow to the source that they're needed and attracted to the most, right? And that's just what is going to happen. And so those banks who make that exit, for all the reasons Jason said, and they'll have to figure out their business model, right? Do they have business models that are going to respond to the demands of the market over the time horizon that their investors and their constituents are looking for, or not? I think we've got front row seats kind of in many dimensions to observing and seeing what's happening. And the amount of capital and most importantly, the amount of customer demand that is present for these services. As we say, we're taking the bank to where the customer is, not making the customer come to the bank, which is what the paradigm has been. And it's not going to stop. It's everywhere you look. The largest brands on planet Earth are seeking to do this. And this is capitalism is going to figure it out. I don't know what the right number is. Is it 20 banks doing it? Is it 50? But sure enough, the banks who match up the ability and the will find the opportunity to do it. So it doesn't matter. It's going to happen, and it'll happen in the right way. And this is and the forces of the regulators, they're a part of that capitalistic environment, right? And they're having their impact on it, and we're all responding in kind, and we'll innovate. Which means regulatory innovation, risk innovation, as well as technological and product innovation.
Yeah, and I agree with what Jason said earlier, right? I mean, if you look 15 years ago, how many banks were in this space? Today, how many banks are in this space? And how many of those entered the space within the last 5 years because there was a good opportunity to make money, right? And so you can definitely expect to see people leaving it, right? Especially, let's say, Five-Star Bank, who were early. They had not really done a whole bunch. They were starting to, and they said, okay, it's not worth our time. We already are a $6-7 billion bank. We're already making money different ways. This is not how we are going to continue doing it. And it's so much uncertainty, right? Now, that doesn't mean that they won't come back in the future, or maybe timing is not right now. Who knows what happens, right? So it's very subjective to each institution as to how they look at this industry and how they make money. I mean, and the more mature banks are probably going to hang in there until the end. And some that are just dabbling with it and they're just trying to get into it are probably going to get out immediately saying, we don't want to do this because it's too risky and we don't understand this. We don't have the staff. We don't have the expertise. We don't have the right business models. I mean, look, Juan, the same way goes out for what if the interchange rule changes, right? And if you don't make enough interchange, then what happens? I mean, similar situations, can come into play where people are making so much money off of the interchange. And if that goes down, they're going to be faced with a similar situation. So I think it's very subjective to each
Yeah.
bank and how deep in the water they are. Just because there is a shark in the water, not everybody's going to get out. There are going to be people out there who are still going to swim and say, I'm going to be okay.
Well, I do want to add that sorry, Juan, real quick. I do think this is going to create greater barriers of entry for financial institutions looking to get into this space, because, those who have like you mentioned, mature banks who have gone through it or are going through it are going to adapt if the model is sufficient enough to be able to be a long-standing business objective, right? And I think those who have, like you mentioned, experienced, kind of gone through the regulatory pressure, been able to adapt and adjust their risk management frameworks, whether that includes how they're going to capitalize the bank, liquidity, interest rate risk, all of those key factors now are going to be very hard for a small community bank to try and get into BaaS from the very beginning, knowing that it has these great barriers that they're going to have to cross in order to get a successful program off the ground.
Okay, so let's shift a little bit to aside from the impact, because we're kind of all assuming, which I think we're taking the risk approach, right, of assuming the worst, right? But as I mentioned earlier, this is an NPRM, and as we've seen, there is time, and they have made adjustments. The regulators have, particularly if they get some pushback. So, question, or at least that's my view, right? But I put it up to the panel. Question for you then: do you think it will help for banks and fintech companies that are impacted by this? And Jason, to your point, even those that are starting to get to comment on this proposal, and if so, out of the provisions that you have seen, where do you think the most focus should be on pushing back? And by that I mean, which of these proposals do you think will impact the largest amount of core deposits right now becoming brokered? To anyone who wants to take
I think the biggest impact could be the revision of the interpretation of the primary purpose exception, right? Because I think that, talking about that and placing customer funds is going to have a huge impact on the IDI. And I think, to me, that's where the greatest impact is going to happen based on, what proposed changes are in the NPRM.
And do you think, Jason, it's worth commenting on this, or do you think this is inevitable?
I think all folks should be commenting on it that have an impact, because I think, looking at the four, I think, there's opportunities for possible clarifications around the subjectivity or confusion around the intent of that interpretation. So I do think that there's, looking at how the NPRM and how banks should respond, I do see certain areas of the NPRM that are just going to try and plug or clear a regulatory gap versus, trying to define or revise any interpretations. And the more feedback that we're giving, obviously, there's been certain letters that are out there, especially like through the AFC, that it can have an impact on how the final rule is going to look versus how it's structured now.
Yeah, and going back, right, Juan, I think everybody should absolutely comment, right? If it's affecting you in any way, you should comment. But I think the key here is simple, right? And I've said this before, and I'll keep repeating this, right? Is you have a set of customers, like let's take Chris as an example, what he mentioned earlier. You have customers that walk into your branch and open up accounts. And then you have customers that you have through fintech relationships that open up accounts digitally. They are your customers. Just because their ledgers are maintained somewhere else, just because somebody else is servicing them and not Fiserv and FIS and Jack Henry, doesn't make them any less of a customer than what your customer that walks into your bank is, right? So that's the key right there, according to me, is like, if this becomes broker deposit, then are all my bank deposits going to become broker deposits too? I mean, where is the line there, right? That's, I think, the key factor here, that it is your customer, third party, fourth party, it doesn't matter. You can have nth party, as long as you know who your customer is, you know how much money they have, you know how they interact with your bank or banking products that you're offering, they are regular customers. It doesn't matter who is in between.
Yeah, I think that's a point that Chris has made a couple of times. already as well, and it seems to be a general consensus of the panel. So, Chris, do you think do you think it's worth commenting on this? Do you think there's a chance that this could be at least amended, if not withdrawn?
Yeah, no, I think for sure, because like I said, this is not adversarial, and the relationship that I think we definitely attempt to take, and all of us should take with the regulatory agencies, is they're an important part of that. I mean, it's one of the things that actually has differentiated our economy over time, right? Is a healthy interaction, sometimes friction, but iron sharpens iron, relationship with regulators. And this is part of it. They've come out, we can see what their concerns are. So we should directly and collaboratively address those concerns and get them fully to the table. So you have to respond. You have to push back, and you have to do so in a fact-based, demonstrable manner. So everyone absolutely should do that. At the same time, you're the attorney, Juan. I'm far from it. Married to one, and I feel like I'm around attorneys all the time. But other than that, I'm definitely not one. And I think that not just the Loper decision, but the other, I forget what the name of it was, Supreme Court over the summer that came out, that requires the agencies to provide substantive responses to all comments. That's real. That's a factor, right? And so we should all be making it known. And the more consensus there is, and the more that they're hearing very logical and consistent, or at least arguments that rhyme, then that lands, that resonates. They're going to pay attention to that. And then further, I think because of Loper and other administrative law cases and judgments, it's highly likely that this will get hung up in the court system for a while. And so the more banks and industry participants have made their voices known and heard in reasonable substantive ways, the better off that the entire process will be.
So outside of, I think the consensus is definitely get involved, and certainly I would agree. I've seen things come out a lot differently. Sometimes never enacted at all. I think we've all seen that, right? NPRMs, and sometimes enacted vastly different than they were proposed. Outside of the commenting period to the panel, if you are a bank, let's say you are in charge of bank partnerships, what would you be doing right now, if anything, to prepare for a final rule? Is this kind of like we comment, and to your point, Chris, it's going to take a while to implement, it could be tied up in the courts, we really don't have to worry about it right now? Or would you be perhaps slowing down the entry into BaaS programs, or thinking about the economics of such programs under a situation where the deposits could be considered broker, when you first started thinking they might be core?
Yeah, I think I can only speak for us. Putting anyone putting their head in the sand and relying upon the courts to deliver a great victory, probably that's probably not the best answer. We can certainly hope for that, expect the worst. So again, people have to look at their business models. There are banks all around this country, really well-run banks, who have been sustained operations for a very long time, who have 75, 80, 90% brokered deposits on their call reports. And why are they able to do that? Well, they had a clear plan, a clear strategy, a really strong risk management program, and they demonstrated through their actions and execution to their examiners and the supervisory structure that they were capable of handling that. And so that, I actually think that's prima facie evidence that a scarlet letter of broker deposits doesn't talk about the fundamentals at all. So it goes back to each institution and alignment with your strategy and your board, and what are your tolerances and why, and what's your risk framework around that. So it's in that sense, it's kind of the agencies are making a great point in know your risk. And so that would be my advice to anyone: know your risk and structure it appropriately, and don't get thrown off by labels that don't actually do anything to describe your risk.
Well said, Chris. And just to mention, I think obviously responding to the NPRM is important, but also making initial preparations, right? Obviously any influence that you can have on the NPRM by providing detailed feedback or ensuring that regulatory language is clear and workable, like we said, in defining interpretations. But simultaneously, if you're a bank, you want to be prudent, like you mentioned, Chris, talking about those that are already there, but analyzing the potential impact that it could have on your financial institutions and develop strategies to mitigate that risk if the rule is adopted as proposed, I think is important. So balancing, obviously, advocacy with proactive internal adjustments is going to ensure that you're not caught off guard if the rule does become into place.
And Juan, I'm not a bank, so it's easy for me to say, right? It's still early. It's like you said, it's a proposed rulemaking. Of course, comment on it. But if I did own a bank, I would hang tight, right? I would not make any drastic changes one way or the other, and I would just watch, because it's not going to happen overnight. It's going to take time. There's going to be time to comply. It's going to become a rule. There's going to be some time that goes by. There's plenty of time. Of course, that means that a lot of folks will get a lot more business if this happens, right? But there is time. I personally feel that right this minute, there is no need to panic.
That's great, Adwait. I like ending that segment on that, and I agree. I think there's plenty of time, and as I mentioned, I think there's time for this to change. So in the last few minutes that we have before we turn it over to see if there's any questions, I'd like to think about what we kind of do every time something. Unfortunately, we tend to do it when something bad happens. I think I like Chris's more optimistic view of being collaborative with the regulators as part of these NPRM, but taking a more cynical view, right, on this NPRM and why this is happening. Could we chalk this to, for example, a different administration? The NPRM in 2020 was under a different administration than we have now, and in less than a month or just about a month, we have elections coming up. Is that really what is again, being very cynical, what is pushing this, or was there something that banks and their fintech partners could have done differently in this instance, perhaps to preserve the 2020? Was there some blame to go around? And I asked this, I think we're here already obviously with the broker deposits, but we got to think about, could this happen, right, to another particular fintech product or service group that could be next, if, for example, there are things that banks and their fintech partners need to do better. So in other words, could banks and fintech partners could have done something differently to avoid being where we are right now? Anyone?
It was kind of a loaded question, no?
I know. I was going to say it's hard to say, right? It's hard to say because I don't think so, right? You can't take a couple bad examples and apply it to everybody. So I would say no. I don't think that there is anything wrong that happened, and everybody did what was right. And then now if the landscape changes, we'll all change the way we do business, but to be seen. That's just my 2 cents.
Yeah, I'll let Chris finish up, but it's hard to talk about different administrations. I think what we can focus on is looking at learning from mistakes, whether understanding what happened with the Synex collapse, understanding where there was potential risk management failures, understanding how banks can shore up controls, but doesn't mean we have to change the entire process. That's something that needs to be evaluated. Obviously, when you have a potential failure or a middleware failure, you want to understand the root cause. And I think those are great opportunities for us as an industry to look back and say, could we have done something different? Yes or no? Or do we just need to strengthen certain frameworks within our own financial institutions?
Yeah, for me, I think it's unfortunate, but it's also fortunate that there's nothing new under the sun, right? There's nothing new here. It's just a different it's a different situation, a different innovation, a different environment. but it's the same cycle that, how many times in the past, I'm sure structured products went through this, commercial real estate went through this, mortgages went through this. And this is where we are again, that there's great innovation, great ideas, great vision of where, innovation is going to go. People get very excited. A lot of money gets thrown at it. It's not totally risk management structured. People get ahead of themselves. There's a blow up, unfortunately. Then the reaction to that, the pendulum reaction this time has been probably an outlier, a standard deviation or a couple of standard dev outlier. And now we're kind of in the wake of all of that. And the response, I think, is just the same. Now the, kind of the panic is subsiding, I hope. It seems like it. And the regulators have now come to the table. They're acknowledging, right, that this is the future, a big part of the future. And those of us who are committed, fully committed, and want to do this the right way are the normalization engine, if you will, that will set this forth. And I think that cycle is likely been repeated in the past over and over. So I'm not overly optimistic, Juan. I think it's very painful. It's not fun. It's unfortunate. And it's, it's very costly in a lot of different ways. But this is just kind of the creative destruction cycle that will continue. There will be something else in the future that rhymes a whole lot with this. And you just kind of have to take that in stride and do the hard work and move on.
Well, thank you, panelists. We have about a couple of minutes. I don't see any questions unless somebody has seen them, and I'm not seeing them in the chat.
No.
I'll give it one more minute in case anybody has any questions that they wanted to ask the panelists on this. But in the meantime, I want to thank all of you for joining and really these panelists for coming forward. This is. I mean, I felt like we could talk about this for another couple more hours, and particularly have another whole webinar on the custody, record keeping for custody accounts, which is a whole different ball game in that area. So not seeing any questions, I think, I don't know if Taylor, if you're around, I'll hand it back over to you and just say thank you to everyone who joined and the panelists for this webinar. We hope to see you at a future webinar.